We all know how hard it can be to memorize complex theories or wrap our heads around big, abstract ideas. But something magical happens when those same ideas are shared through stories. When a teacher or author brings a concept to life with relatable characters and simple situations, understanding becomes effortless and even enjoyable. Investing is one of those topics. For some, it's crystal clear, but for many others, it still feels overwhelming, boring, or downright confusing. That's why today's book summary takes a different path. We'll explore the ideas not through dry definitions or technical terms, but through a story designed to make even the most complex financial ideas easy to grasp. Hello, and a warm welcome to Audiobook 101, the place where powerful ideas from best-selling books come alive. Here, you don't just listen, you learn and grow. Today's book is The Little Book That Beats the Market by Joel Greenblatt, a best-selling classic that simplifies investing like never before. And we'll walk through its ideas in the form of a story that anyone can follow, even if you've never heard of terms like return on capital or earnings yield. So, let's begin. Meet Jason. He's a sixth grader with a surprisingly successful chewing gum business. But don't be fooled. This isn't just a cute school project. Jason's business is thriving. And here's the exciting part. You can do something just like it. The secret? It's all in the magic formula, a simple but powerful approach to investing that we'll uncover together in this summary. Don't know anything about investing? That's perfectly fine. Is this your first time hearing big financial terms? No problem. This story will guide you gently, one step at a time. Every complex idea will be explained through relatable examples, so you can follow along easily and start building your understanding with confidence. All you need is a little curiosity and trust. Yes, trust in the process. Because before Jason discovered the magic formula, he was just like you, uncertain but ready to learn. And what he found changed everything. Jason is a classmate of my son, and believe it or not, he's already quite wealthy. He's only in the sixth grade, but he runs a business that's doing surprisingly well. Every day, Jason buys 4 or 5 packs of chewing gum. Each pack costs him 25 cents. But instead of selling the entire pack, Jason sells each stick of gum individually for 25 cents each. So, from a pack that cost him just 25 cents, Jason earns $1.25. Not bad for a sixth grader, right? Curious, I asked my son Ben how much money he thinks Jason will make by the time he finishes high school. After thinking it through, Ben said, probably around $4,000. That got me thinking, so I posed another question to him. If Jason offered you half of his future business profits, how much would you be willing to pay him today? Ben did some quick math again. He adjusted his estimate, saying Jason might not make $4,000, but around $3,000. Half of that is $1,500. So I asked, would you give Jason $1,500 right now for that deal? He shook his head. No way. Ben explained that giving someone $1,500 today for money that will come many years later doesn't seem like a smart deal. Plus, there's no guarantee Jason's business will stay successful. Anything could happen. Eventually, Ben came up with a number he was comfortable with, $450. That's what he said he'd be willing to pay for half of Jason's future business profits. At that moment, I smiled and told him he was finally starting to understand what I go through when I invest money. As a kid, Ben had never seen me buy chewing gum or sell anything. So he asked, "What do you mean?" I said. In business, I try to buy things for much less than what they're actually worth. Ben thought for a second and said, Well, that sounds easy. But why would anyone sell a $1,000 business for just $500? A fair question, and one that many people, kids and adults alike, often wonder. It's to answer questions like this and to explain how you can make smart decisions with your money that I decided to write this book. To understand how luck works, and more importantly, how you can create your own luck, you'll need to hear a full story, and you'll need to trust it. By the end of this story, you'll discover a magic formula, one that might just help you become rich. But there's one catch. If you don't believe it can work for you, it probably won't. Spending money is easy. Saving it? That's where things get tricky. When I was a kid, I decided to spend all my savings on a company called Johnson Smith. They sold all kinds of novelty items like whoopee cushions and itching powder. One day, I bought a giant balloon from them. It was 10 feet tall and 30 feet wide. My brother and I somehow managed to reverse the airflow of our vacuum cleaner to inflate it. The balloon grew so big it wouldn't fit through the front door, so we pushed it out with our backs until it finally squeezed through. But there was one little thing we forgot. The air inside the balloon was warm, and the air outside was cold. Everyone, except for me and my brother, seems to know that warm air rises. Before we knew it, the balloon lifted off and floated away into the sky. We chased after it for nearly half a mile until it got stuck in a tree. That day, I learned a valuable lesson. Never spend your money on a balloon so big that you have to run 3 miles to catch it. So, if you're not wasting your money, what should you do with it? Save it, of course. Let's say you manage to save $1,000. What now? Where should you keep it so that it grows into more than $1,000? You could stash it in a piggy bank or under your pillow. But years later, when you check, you'll still have just $1,000. No more, no less. And because of rising prices, that money won't buy as much as it could today. In simple terms, your pillow isn't going to make your money grow. So, let's consider Plan B. You put the money in a bank. Not only is it safe, but the bank will also pay you interest every year. Over 5 years, your $1,000 could turn into $1,267. Not bad, right? But there's also a Plan C. I like to call it, Who Needs a Bank? In this plan, you skip the bank altogether and lend your money directly to a business through something called a bond. For example, if you buy a $1,000 bond from a well-known company like McDonald's, they might pay you 8% interest each year and return your full $1,000 after 10 years. That's even better than the bank's offer. But of course there's a catch. If the company runs into trouble, you might not get your interest or even your money back. That's why riskier companies have to offer higher interest rates than big, stable ones. Now, if you're someone who doesn't like taking risks, there's another option: government bonds. These are considered risk-free investments. Let's say the government offers a 10-year bond with a 6% annual return. That means you can lend your money to the government and get a guaranteed 6% every year. Here's something to think about. If someone wants to borrow your money for 10 years, they better offer you more than 6%. Otherwise, why would you take the risk? After all, you could earn 6% without any risk by just lending to the government. That's why understanding interest, risk, and return is so important. Because when it comes to growing your money, it's not just about where you put it, it's about how smart you are with it. Now that we've looked at a few smart ways to handle your money, let's explore another important idea. how do you actually invest in a business? Let's go back to Jason. As time goes on, Jason grows up. Maybe his little gum-selling hustle turns into something much bigger, a full-fledged chewing gum store, maybe even a chain of stores. Now he wants to buy a limousine, maybe a fancy house, and to do that, he decides to sell part of his business. Let's say Jason wants to sell half of his gum business for $6 million. That's a huge amount, more than most people could ever afford. So instead of trying to sell the business in one big chunk, he breaks it into smaller pieces. 100,000 pieces to be exact. Each of those pieces is called a share. Jason plans to keep 500,000 shares for himself and sell the remaining 500,000 shares to the public at $12 per share. That way, everyday people like you can become part owners of his business. Let's say you decide to buy 10,000 shares. That means you now own 1% of Jason's company, but that doesn't mean you own a tiny part of one physical store. It means you're entitled to 1% of the company's future profits, the money Jason's business will earn going forward. Now comes the big question. Should you actually buy those shares? Jason provides you with detailed information to help you decide. He tells you that last year, his company made $10 million in sales. That's the total amount of money he collected by selling gum, not the actual profit. Of course, running a business involves expenses. First, the cost of the gum itself, $6 million. Then come other expenses, rent, salaries for employees, electricity, and so on. All of that adds up to another $2 million. So now we're left with $2 million in pre-tax income. But wait, there's more. Jason has to pay 40% in taxes, which knocks off another $800,000. In the end, the profit his business made was $1.2 million. Jason shares all this data with you in something called an income statement, a financial table that breaks down the money earned and spent. So what does that mean for you? If you invest $12 per share and the company earns $1.2 million in profit, your return for the first year would be 10%. That's a much better return than a bank, or even many bonds, which might only offer 6%. Sounds like a great deal, right? Not so fast. You still have to ask a few important questions. First, that $1.2 million is last year's profit. What about next year? Will the company make more money, the same amount, or less? Second, how confident are you in your prediction? Business is never certain. It can grow, shrink, or stay flat. Many factors can affect profits. And third, is this a business that has real potential for the future? If all of this is starting to sound a little confusing or overwhelming, don't worry. You might be thinking, I'm not sure I can make these calculations, or I don't want to take that kind of risk. But stay with me. Just trust the process and keep listening, because the story is only getting started. A few years ago, I was teaching an investment course to business students at an Ivy League university. On the very first day of class, I'd walk in holding the financial section of a newspaper. I'd ask my students to name some of the biggest companies they knew. Without fail, they'd mention giants like IBM, General Motors, and General Electric. Then I'd flip through the paper, find those companies, and point out something surprising: the highest and lowest prices their shares had traded for over the past year. I'd ask the class, how is it possible that shares of a massive company like IBM could be selling for as high as $93 and as low as $55 in the same year? Isn't that the same company with the same business, the same assets? Now imagine Jason's chewing gum business again. Let's say you estimated each share of Jason's business to be worth somewhere between $10 and $12. But at different times throughout the year, those shares were being sold for as low as $6 and as high as $11. If you knew what the business was really worth, wouldn't it feel like a mistake to buy a share at $11, but an incredible deal to buy it at $6? This is exactly how the stock market works and how smart investors think. One of the greatest investment writers of all time, Benjamin Graham, explained this idea using a brilliant metaphor. He told readers to imagine a man called Mr. Market. Mr. Market is your business partner, but he's a bit moody. Every day, Mr. Market shows up at your door and offers to either buy your share of a business or sell you his. The problem is, his mood swings wildly from day to day. Some days he's extremely optimistic and demands a high price, far more than the business is worth. Other days, he's gloomy and scared, and he's willing to sell you his shares for much less than they're really worth. The important thing is, Mr. Market is not your guide. He's your opportunity. You don't have to agree with his mood. You don't even have to respond. You simply wait for those rare moments when his offer gives you a clear advantage, when he's being irrational in your favor. That's how the stock market works. Prices rise and fall, not always based on logic, but often driven by emotion. Fear, excitement, rumors, or trends. So what should your strategy be? It's simple. Buy when Mr. Market is feeling down, when good businesses are selling for less than they're really worth. The difference between what a business is truly worth and the price you're paying for it is called the margin of safety. The greater that margin, the safer your investment. Keep this idea close. It's one of the most powerful tools you can use to invest wisely. And now, you're ready to go even deeper. One of my favorite movies growing up was The Karate Kid. There's a scene in it that has always stuck with me. In the movie, the wise and elderly karate master, Mr. Miyagi, agrees to teach his student, Daniel, how to fight, but instead of showing him kicks and punches, he puts Daniel to work, washing cars, painting fences, sanding floors. Over time, Daniel grows frustrated. He doesn't understand why he's doing these boring chores instead of learning karate. Finally, Daniel confronts Mr. Miyagi. But just then, something amazing happens. Mr. Miyagi begins throwing punches at Daniel, and instinctively, Daniel blocks them using the exact movements he learned from waxing the car and painting the fence. With one swift move, Mr. Miyagi says, "Paint the fence." That's when Daniel realizes the truth. Through these simple exercises, he had unknowingly been training like a karate master all along. The lesson? Sometimes, the simplest tools can prepare you for the most powerful outcomes. And that brings us back to our story's hero, Jason. Earlier, we looked at Jason's business and calculated a 10% return on investment. How did we do that? By dividing the earnings per share by the price per share. This is called the earnings yield. It tells us how much profit you're getting for every dollar you invest. But calculating return is just one side of the equation. Now we have to ask, is this actually a good business? Let's say Jason has a friend named Jimbo who also runs a chain of stores. His business is called Just Broccoli. And yes, he only sells broccoli. Imagine you're given a chance to invest in either Jason's gum business or Jimbo's broccoli empire. Which one should you choose? Well, let's look at the numbers. Last year, Jason's business made $200,000 in profit. Jimbo's made only $10,000. That's a huge difference. And if Jimbo's profit represents just 2.5% of what he invested, that's not exactly a great return. So clearly, Jason's business looks better, not just because it made more money, but because it used its resources more efficiently. And here's the key takeaway. If you want to succeed as an investor, all you really need to do is remember two simple rules. 1. Buy shares of good companies. 2. Buy them at cheap prices. That's it. Just like Daniel became a karate master by practicing simple moves, you can become a stock market master by sticking to these two principles. The combination of quality and value, a good business at a great price, is the secret to building long-term wealth. Now, we're ready for the moment you've been waiting for, the magic formula. So, what do you think would happen if we decided to invest only in companies that are both highly profitable and deliver a high return on capital? And what if we made sure to buy their shares only when the price is low? That's right. We'd likely make a lot of money. But hold on. Do you really think things are that simple in the real world? Before we jump into the formula, you should know that even legendary investor Benjamin Graham had his own version of a formula. He believed in buying stocks only when their prices were so low that the cost to buy the company was less than what you could earn if the business was shut down and all its parts were sold. In other words, he wanted a margin of safety so big the risk practically disappeared. So, what does our magic formula look like? It starts with a universe of about 3,500 of the largest companies that trade on a major U.S. stock exchange. From there, the formula ranks every company in two ways. 1. First, by return on capital, a measure of how efficiently a business uses its money to generate profits. The higher the return, the better. Second, by earnings yield, how much profit the company is generating relative to its stock price. In other words, how cheap the company is based on its earnings. Each company gets a ranking for both categories, from 1 to 3,500. Let's say a company ranks 230th in return on capital and first in earnings yield. We simply add those two numbers together. 230 plus 1 equals 231. That's the company's final score. The companies with the lowest combined scores are the ones the formula says we should invest in because they are both high quality and undervalued. This simple yet powerful system filters out all the noise. It doesn't rely on market predictions, news headlines, or gut feelings. It focuses on just two things: how good the business is and how cheap the stock is. That's the magic of the formula, and it's one of the most effective tools for long-term investing success. I've always found it hard to understand how America won the Revolutionary War. Think about it. 13 scattered colonies took on the might of the British Empire. Britain had the world's strongest army, the most powerful navy, and more money than anyone. And yet, somehow, the colonies pulled off a win. How could that be? Well, I have a theory. I think we won because we were fighting against people who stubbornly stuck to old ways. The British troops stood tall in bright red uniforms, marching in straight lines, following tradition. Meanwhile, the Americans were hiding behind trees and rocks, taking cover and firing with strategy, not ceremony, and that made all the difference. What puzzles me is how the British didn't adapt. After losing once, they stuck to the same approach again and again, and eventually it led to their defeat. So, what does this have to do with investing? Everything. You see, we now have our own version of a winning strategy, the magic formula. It's worked again and again in the past, but before we rush in and pour all our money into it, we have to ask an important question. If everyone knew about this formula, would it still work? Here's the truth. The magic formula doesn't work all the time. In fact, there are months and even entire years when it seems like the formula isn't working at all. And that's what makes it hard to follow. No one likes to lose money, even for a little while. Watching your investments go down can shake your confidence, even when you know the strategy is sound. But if the formula did work perfectly, all the time, everyone would use it. And if everyone used it, the opportunity would disappear. The edge would vanish. So, in a strange way, we're lucky the magic formula doesn't always work in the short term. That's what keeps it from becoming overcrowded, and what keeps it valuable for those who stick with it. The biggest challenge isn't understanding the formula. It's having the discipline to follow it, especially when others doubt it. Let's continue where we left off. We've just discovered a simple strategy, a magic formula that is proven to beat the market over time. But here's the truth. Most people don't want to hear. Sticking with the magic formula isn't easy. Why? Because it doesn't work every month. Sometimes it doesn't even work for an entire year. And that can be frustrating. Imagine following all the steps, doing everything right, and still watching your investment returns drop while your friends brag about how much they made on the latest trendy stock. It's not easy to stay calm when everyone else seems to be winning. That's why most people don't stick with it. They give up when it gets uncomfortable. They doubt the formula when the results don't come instantly. They jump ship at the first sign of trouble. But here's what you must understand. If the magic formula worked perfectly all the time, everyone would use it. And once everyone starts using the same strategy, it stops working. That's why the magic formula still works, because most people lack the patience to follow it. In a way, we're fortunate. We're lucky that it sometimes underperforms. We're lucky it requires discipline, because that's what keeps it from becoming too popular. And that's what allows it to keep generating strong returns for those who stick with it over the long run. The real magic isn't just in the formula itself. It's in the patience, the discipline, and the confidence to follow it, even when the journey gets tough. I'll admit something. I'm not a great sailor. But that's never stopped me from enjoying time on a boat. I love the experience, even if I'm not especially skilled at navigating the waters. Interestingly, that's exactly how many people feel about the stock market. They may not be professional investors or financial experts, but they still want to pick their own stocks. They enjoy the thrill, the challenge, the freedom of making those choices themselves, even if they ignore a proven strategy like the magic formula. If that sounds like you, there's something important I want you to consider. Picking random stocks without deep research is like walking through a dynamite factory with a lit match. Sure, you might make it out unharmed, but let's be honest, that's not courage. That's recklessness. So, how exactly do you choose the right stocks? To do it well, you have to estimate how much money a company will earn, not just next quarter, but over the next several years. You need to predict future profits, costs, risks, and how those will affect the business's value over time. Now, is it impossible? Number. But is it hard? Very. Accurately forecasting a company's future earnings is one of the most challenging parts of investing. Even experts get it wrong, often. That's why the magic formula exists. It saves you from having to make impossible predictions. Instead of guessing the future, it helps you make decisions based on present reality, based on numbers that already exist. So here's the bottom line. If you can't confidently analyze a company's future, stick with the formula. The magic formula doesn't promise perfection, but it does offer something incredibly rare in investing, a simple, reliable method that works over time. You don't need to be a market genius. You don't need to spend your life reading earnings reports or predicting industry trends. All you need is discipline and the patience to follow a strategy that's proven to work even when it doesn't look exciting or trendy in the short term. In the end, investing isn't about flashy moves. It's about smart, consistent decisions. And that's exactly what the magic formula helps you do. There's one thing I've never had the heart to tell my kids, the truth about the tooth fairy. Maybe it's because I want them to hold on to their childhood innocence just a little longer. In our home, I don't mind if my children believe in fairy tales for a while. But when it comes to the stock market, there's only one version of the story I want them to know. There is no tooth fairy here. In investing, money doesn't magically appear under your pillow. There's no invisible hand that drops wealth into your lap while you sleep. Unfortunately, many people still behave as if it might. They turn to stockbrokers for help, people trained to sell investment products. And while a broker can help you, remember this: brokers get paid to sell, not to make you rich. Whether or not you earn money may not be their priority. Then there's the option of mutual funds, a mix of stocks and bonds managed by professionals. Sounds good, right? Well, maybe. But again, you're taking a risk. Many mutual fund managers also get paid for selling products, not necessarily for delivering results. Their incentives may not align with yours. They might not be focused on growing your wealth. They might just be focused on growing their fees. In short, don't count on someone else to do the hard thinking for you. Here's a simple rule to remember. If someone tries to sell you one stick of chewing gum for 25 cents, don't buy it. Save that 25 cents instead. Because small savings done consistently can shape your future. Every little bit counts. So wherever you are and whenever you can, save. Build the habit. Respect your money. And most importantly, stay smart with your investments. I hope this summary and the step-by-step ideas we've explored helps guide you toward your financial goals. You now know what Jason learned. You now have the formula. And with that, you're ready. Go forward. Be wise, and become the Jason of your own life. Thank you for listening to this summary of The Little Book That Beats the Market by Joel Greenblatt. We've explored how investing doesn't have to be complicated. With just a little discipline, the right mindset, and a simple, proven formula, you can take control of your financial future without relying on luck, hype, or guesswork. If this story helped shift the way you think about money, investing, or decision-making, I encourage you to take action. Start small, stay consistent, and trust the process. And if you enjoyed this audiobook summary, don't forget to subscribe to Audiobook 101 for more powerful insights from life-changing books. Leave a comment sharing your biggest takeaway, and let us know which book you'd like to hear next. Until then, keep learning, keep growing, and remember, sometimes the smartest thing you can do is keep it simple. Stay wise, stay curious. And I'll see you in the next summary,